Tell us about, kind of how you started your career and where you're at today.
Yeah, so I started when I was 13. I delivered newspapers and I took my money and invested it in rare coins. And the rare coin dealer was a commodity trader.
Wow.
So at 13, he would let me trade on his account with my money, though. And that's how I got started. But so by the time I was 16, I had written, this is in Canada. I grew up in Toronto. I had written my exams to be a broker. And of course, nobody would hire me at 16. So I went and studied math. I got a scholarship to study math at University of Waterloo. And then I joined Prudential Beige, it was then, and moved on to Bank of Montreal, ran a proprietary trading group for them. They moved me to Chicago and I became the first director of managed futures. And then I left to start my own investment business. So that's how I got going and basically been a CTA ever since then.
Very cool. I love how you got into the business. 13 years old, probably earlier than most.
Oh, this was my dream business and still is.
So what attracts you to commodities?
Well, I guess when I got started, I was born in 64. So in the 70s is when I was a kid, the mid to late 70s. That's when commodities were going crazy and there's lots of inflation and stocks were kind of were undesirable then. So I think that planted the seed for commodities. And then in 2006, I developed a program to front run the long only commodity funds, which had gotten big and sort of around that time. And we were probably the first big player to do that, the first hedge fund to do that. And that program was very successful and grew to over 500 million pretty quickly. But that commodity business sort of died out a little bit in around maybe 2012 or 2013. A lot of people divested out of commodities, so the excitement wore off. We ended up merging with another Katonah Capital Partners and formed Katonah EBE, and we started getting more into some other managed futures like machine learning and stuff like that. And we're still doing a lot of that today. So it's pretty cool.
It's give us the kind of the picture of commodities over the last, I don't know, since 2000. Obviously they had a great run, kind of going into the Great Recession, 2008. They've been really stagnant up until maybe the last couple of years, and like you said, a lot of people have divested. Kind of give us the story of the last, up to 2000s.
So probably from 2005, so preceding the big recession, commodities started getting popular as an investment vehicle. So everybody wanted to have commodities on their book as an investment vehicle. The problem is commodities are really not big enough to be part of the sort of $100 trillion investment world. But everybody would buy in the Goldman Sachs Commodity Index and all this. They would start all this, and essentially people were investing in commodities as a sort of standalone vehicle, and that drove prices up. I mean, that was a lot of just buying that had nothing to do with supply and demand. So that drove prices up through 2008, 9, 10. And it got really big, it got into the hundreds of billions of dollars. And of course, the problem with commodities is when you buy and drive prices up high enough, production will also increase eventually and catch up. And by then, because the demand was not anybody who actually wanted to consume the commodity, you ended up with oversupply and prices then had to come back down. And then everybody kind of got out of commodities. It lost its favor. And now things have sort of evened out and maybe the process is starting because it is an interesting investment vehicle for a lot of people. So that here we are probably starting a new round. Plus you have to think, I think we're starting into an era of inflation. So let me go back to World War II. We came out of there with huge debt, GDP to government debt was over 100% debt to GDP. And they inflated it away through the 50s, 60s, and 70s. And it came down to 35%. And then they squashed inflation and everything was fine. But now debt's back well over 100% of GDP. And the only plausible way to get out of it is to inflate it away again, which is what they're going to do. They're going to inflate it away. So you're going to see a couple of decades probably of rolling high inflation, and commodities are the natural vehicle to be in during that. Commodities, maybe housing, hard assets, and crypto.
Yeah.
What other trends are you seeing, I guess, in the managed futures CTA space? I guess obviously, as you mentioned, inflation is your friend. Volatility obviously can be your friend as well. I'm just curious for folks who are not well versed in the CTA managed futures space and they're looking into different aspects.
Well, I think there's been a bit of a paradigm shift. So let's say from 1980 all the way into just a few years ago, bonds only went up. And all of a sudden that's changing. So a lot of CTA programs that kind of were based on bonds only going up kind of have self-destructed now. So I think now, do equities keep going up? I don't know. I mean, that's a tough question. It might be some difficult years ahead, but I think, like you said, there's going to be a shift into more commodity-based stuff. Now you're seeing a lot of AI and things like that. But the problem with AI is it starts learning like that bonds never go down. And then when that shifts and bonds do go down, it has a hard time, machine learning or AI. So the technology is getting more advanced, AI and machine learning, but it's also sometimes not doing the job. So I still think, AI is going to change trading. One of my concerns is that everything becomes bot driven. And then all of a sudden you have periods where you have something goes terribly wrong and all the bots turn themselves off, or their controllers do. And all of a sudden the liquidity is completely gone, especially in equities. So I think there's going to be possibly some scary times ahead, which is just going to create more opportunities for traders.
Yeah, definitely. I agree. I've even seen, to your point, on the other side where bots or algorithms continue to trade and flash crashes do happen, right? Given the things that would happen. And to your point, it's you still need a human in the loop. You still need the expert, right, to be able to control and provide guardrails around what's happening there. But yeah, it should be interesting for sure.
And in a lot of cases, there isn't a human in the loop.
You're exactly right. Yeah, the algorithmic trading process.
So look at the flash crash in 2010 and the chaos that caused just by bots. But bots were a small percentage relative to today. So if you had just the right combination of events, you could have something much bigger than the flash crash.
Absolutely. Totally agree.
Talk to us about some of the strategies that are interesting to you on the CTA side, whether it's strategies that your team implements or strategies that you've seen out there that you like during this current time period.
We have a portfolio manager, Kevin Doyle, who used to work at Crable Capital, super sharp guy, who's developed a program that's long only, but it has a trend component to it. But he's figured out that a lot of these asset classes, all the money is made on the upside. So he's built a program around that. And essentially it gets out of the market when it's going down and just sort of leans on asset classes that are going up. And so it actually does very well over time with a much better risk profile than just straight 60-40 or whatever kind of investment. So that's good. And then we have another program that uses machine learning, and we've been adapting that to the changing marketplace, and the changes really look good. So we've been pretty happy with that lately. And also we have a commodity program that's built and developed by using ML and AI to trade commodities. And so it pivots very well with the changing market conditions. And it specializes on using term structure in commodities, which we believe. So I traded spreads for many, many years when I was, front running the long only funds. And we knew that term structure is probably the biggest driver in commodities. So depending on how the term structure is, that's where the commodity goes. And it uses that, those kind of factors along with machine learning to predict the market.
Could you briefly break down just what a term structure is for those that are listening?
Yeah. So in the futures market, there's the front month or the spot price, and then the prices of the futures contracts going back. So if you want to buy crude oil a year from now, you can buy a contract for delivery in 1 year, and that's going to have a different price. And so that price, the price going out into the distance, is the term structure. So typically, if the market is oversupplied, like if there's too much crude oil in the market, the cash price is going to be low, and then the price is going to go up in the term structure going out in time. And the same applies to almost all commodities. So you sometimes have an upward sloping term structure or a downward sloping, and that tells you a lot about the market condition.
Appreciate you breaking that down. Talk to us about in terms of like the market right now. What are you seeing in terms of like interesting commodities? Like earlier this year, I think it was like cocoa was up like something crazy, like hundreds and hundreds of percents. What is there anything else like that happening right now that kind of stands out to you, whether it's like agriculture or anything else?
Well, I think cocoa was interesting. I mean, they obviously had a problem with the crop in Africa. And now the thing with cocoa is the users can adjust what they do. Like they can put more nuts in a chocolate bar and less cocoa, and they can do things like that, or more sugar. They can adjust. So eventually, it's going to come back into line. But there was a shortage, and that drove prices up. And I guess that's how commodities go. Now, in energies, I mean, we've gone from, years ago, crude being in the 30s, 40s, 50s, to now it's being in the 80s, 70s, and 80s. And I would say we're probably sowing the seeds for another crude collapse down the road. The shale production is very profitable at current prices, and they're going to keep increasing production. And there's like a couple of year lag time. And then there's also a lot of offshore oil, like Guyana and stuff like that, where they just keep drilling new big wells and things like that. But it takes years to come. And at these prices, they're going to keep doing that. And eventually, what's going to happen is they're going to squeeze OPEC. So right now, demand's okay, but you're going to get a recession, and demand's going to go down. And yet that production, that shale production and some of that offshore production is going to keep going up. And OPEC's percentage of the market's going to go down and down. And then they're going to get mad, and they're going to just flood the market with oil, and prices are going to collapse to nothing. So that's one of the things. One of the other interesting things that's going on is power requirements of AI. So all these data centers are increasing power requirements. And really, where's that power going to come from? It's going to come from nat gas. So they're going to need a lot more nat gas. The U.S. has a ton of nat gas. I think in other countries, it's going to come from LNG. And a lot of that LNG is going to come from the U.S. So I think natural gas production is just going to go up and up and up for probably decades. And it's going to be kind of interesting what this power requirement is going to end up being. So people talk about like Bitcoin mining using a lot of power, but it is just a drop in the bucket compared to what AI is going to require.
Yeah,
Definitely. Yeah, it's an interesting paradigm, right? Where we're going into, where everybody was complaining about the power usage of Bitcoin and mining aspects. And now, to your point, AI is a whole another ball game.
Yeah, and to that point, like Bitcoin mining is actually very flexible, right? So they can mine it when power demand is low. So it actually doesn't really require much extra power. It's just it fills in the gaps where power demand is low. But data centers need power all the time. So even the use of renewables can be difficult because it's not always stable. So you need something with a stable production, which is really nuclear or nat gas. At least with nat gas, you can increase production of electricity because you can use more nat gas if needed. I mean, that was the advantage of coal too. I mean, if you got a super cold winter and you needed to produce a lot more energy, coal could do that. But now nobody wants coal anymore. So I guess the natural replacement is nat gas.
Anything else on the CTA side that's jumping out at you these days?
Well, like I said, I think there's going to be a paradigm shift in the markets, in the financial markets, with regards to rolling inflation, which I think is inevitable over the next 20 years. And I think that's going to, I mean, if you consider the debt situation and what that could do to bonds, I mean, there's a chance of bonds really imploding. And like, you don't know when it's going to happen, but if it starts happening and people start to wanting to unload their US treasuries, I mean, you could get some very dire situations. So I think there's going to be a whole shift towards commodities, away from bonds. Equities are going to have their up periods and down periods. And it's going to be a very different and interesting time.
Yeah. And obviously you started your career with the coin side of things, like you were telling us. Are you a gold bug?
No, I'm sort of the gold 2.0, which is, cryptos. So that's where I think it's going to be. And cryptos have the same characteristics in the sense that, like, a lot of people want gold because they don't want the government watching over them, right? And I think the crypto community has the same, like the oversight of the government sort of intruding into everything you do. People don't like that, and gold bugs don't like that, and crypto people don't like that. But I think crypto is sort of where it's at now.
Yeah. And that's a wonderful transition right there. Why don't you tell us a little bit about what brought you into the crypto side? What's your crypto story? How'd you get into it?
Well, I was very interested in crypto for quite a few years, and we started building strategies. So it was very natural for me as a trader to start building strategies in crypto. And it was interesting. I mean, I didn't really look at, like, I wasn't sort of down the rabbit hole. I was just looking at it as a trading vehicle. The more you learn about cryptos, the more you sort of understand what it's all about, and you do go down the rabbit hole. So I am now. But essentially I looked at it as a way to make alpha. Like, there was just seemed to be lots of alpha opportunities. So we were doing actually trading, and we were managing money for other crypto funds. We pivoted from that in the sort of crypto winter in 2022, after, with the FTX debacle and all that. We started saying, hey, there's a lot of very sophisticated tech groups doing crypto trading, but they don't have much money. So I just decided to put my money behind these guys and try to find the best ones. And so we're doing, like, all separately managed accounts through an offshore vehicle. And, we're looking for guys who can create alpha. And the alpha in crypto is just a multiple of what it is in any other asset class. So it's just amazing that, you can just do very well. There is issues. There's counterparty risk. You got to go through offshore exchanges, all this kind of stuff. But the alpha, just trading it, is very, very high. So we decided to set up a big portfolio of managers. There tends to be almost no compliance at any of these managers. So we said, okay, if you have a good strategy, we'll work with you on the compliance side. But the returns are outstanding. So it's our hope to launch a fund on that in the fourth quarter.
Yeah, for sure. It's very interesting, Emil. And obviously, I would imagine you can give your insight to this coming from the CTA world, doing due diligence on these managers. I'm sure you have a unique perspective because I'm sure there's some characteristics that lend itself nicely to what you've already done in the CTA space as a foundational element to how crypto trades and how it operates from a volatility perspective and all those things. But from a due diligence perspective, I'd love to hear your thoughts on how you kind of think about doing due diligence on these managers and what you're looking for.
Yeah, so we limited a lot of the due diligence to the trading side. So like I said, compliance is a mess. And not, I'm not saying that these people are dishonest. They come from a different world. So they're not used, like we've been working with, the regulators and compliance for decades. So we know what's needed, and they don't. So we just said, can they trade? And the due diligence we were doing is, okay, what are the strategies? There's arbitrage, there's directional, there's stat arb and stuff like that. And it was very easy for us to measure that the alpha, and all these strategies were pretty short term. Generally, trade lengths are under a day in the stuff we're looking at. And we know also that, from the managed futures side, when you get trade durations of like a day or less than a day, the correlations between the managers basically go to zero. So you can have 8 managers doing kind of similar things, and they're not correlated to each other. So all we tried to do is to see, do they have an edge? I mean, they all have factors. It's all systematic. Do they have an edge in what they do? And so we can tell if they can talk the talk, and then we open a test account. So we open a 100K test account and get them to trade. And it's all in a managed account that we control. So if they are dishonest, we can shut them down in 2 minutes. So we're not really taking much risk. And we just watch them trade. And if they're doing what they say they can do, then we just start increasing the allocation. And it's kind of amazing because you can have directional managers who will capture all, basically if Bitcoin's up 100%, they're going to make 100% too. But if Bitcoin's down 50%, they're kind of going to make money on that, instead of, if you were just long, you're going to lose your shirt. So they can make money on both sides of the market, but they have different paths to get there. And if you get 8 different managers that aren't correlated, the actual equity curve is pretty smooth. So that's sort of the idea, that you can get this really smooth equity curve with these guys who have tons of edge, and Sharpe ratios are, let's say by manager, maybe 2 or 3 or 4. So much higher Sharpe ratios than you see in traditional assets. And then you take the non-correlation, you get a portfolio of 12 non-correlated guys with Sharpe ratios of 2 or 3. I mean, the results are just tremendous.
Yeah, that's really cool. And I love the approach with the SMAs. Tell us about, is there, when you, maybe let's just take a step back. How do you go about maybe finding these folks, these crypto managers that you're investing with?
Well, we're networking with everybody. So we actually talk to some guys who do third-party marketing, and it's amazing the sort of crazy people they come up with, but some of them have really good strategies. And then we talk to other allocators, and we say, who do you have that's good? And like in the hedge fund world, nobody would ever tell you, right? But in crypto, people will tell you. So we just ask around other investors and stuff. And also it means that if we find a manager and we're doing our due diligence on it, one of the things we do is we ask around, has anybody used this person, right? And then we start checking their track record, what they're posting. So we always ask for daily returns, and we check it against the friend that we find who has them as the manager. And if we think they're posting misleading returns, then they're done, because that's just, you're not going to accept dishonesty. But then if we do a test account, once we get past that stage, we do a test account, We see the returns rolling in. I mean, sometimes they're good, sometimes they're not good, but we've never had anybody really get annihilated. Like if they don't do well, they're like flat. So we just watch them, and we also watch it against their posted returns. So we want to see that everything is, they're fully accountable. And then let's say we have 8 short-term directional managers, we can compare them against each other. Or let's say we have 4 stat arb managers, we can compare them against each other over time. And so, that's how we sort of grow the portfolio and try to find the best of breed in each style of trading. And then the different styles of trading tend not to be correlated to each other either. So there's like arbitrage. The arbitrage guys are interesting because they make steady money. They don't really have many drawdowns. But they have some periods where they make exceptional returns, and it's actually predictable. I've never actually seen this in traditional hedge funds, but we can actually monitor what's going on in the market, and we know when we're coming into a period where they're going to make exceptional returns. And so you can just double or triple their allocation then. And they're usually good with that too. So that's the whole process. And we do know in a bull market, the opportunity set just expands dramatically. So in a big bull market, and I think another big bull market is coming, if that happens, these guys will just print money.
Yeah, really interesting. Is there obviously, to your point, monitoring these managers is crucial on an ongoing basis. I'm sure many of them haven't managed money before. Like you said, they're from a different world. So coming into this, which is pretty unique. Is there a certain amount of track record you look at first? That what they've done. Obviously, you ask around, you kind of get a sense of what they've done so far. Is there a certain kind of hard line you look at, or it's kind of subjective across the board?
I would say you need to have 6 months of data.
Okay.
So like if they've really done well for, like, you'd like to have 2 or 3 years. So if they have 2 or 3 years of verifiable returns, then we'll probably expand them faster. But if they only have 6 months, I mean, those 6 months have to be really good. And then we'll just roll with it. Like if they keep doing what they're doing. I mean, we have one manager and he was making 10% a month. And so we started, and he's probably in a couple of 2 or 3 months up 70% or something like that. We're leveraging him up a little bit, but he's up a lot. So we'll just keep going with it, Smart guy, like we knew he was a smart guy. We think there's probably going to be a big drawdown in the future, but maybe that's okay. That's why we diversify. So we try to say that in the fund we intend to open in the fourth quarter, the maximum allocation to any one manager is 20%. And that's to an arbitrage firm, which doesn't take much risk. Outside of that, among directional, it's probably 15%. So we know that maybe there's going to be some bumps in the road, but if you keep it well diversified, I think that's fine.
Yeah, definitely. Obviously, in managed futures world, leverage is a common practice. On the crypto side of things, is that you guys take advantage of leverage in certain aspects? Obviously, you mentioned yes for this example, but what are your thoughts there?
Yeah, it's basically the same. So like people say, oh my God, like the risk in crypto. And I'm like, look, I traded natural gas options. I don't know. Like the risk is the risk, right? Like you trade according to the risk. And if it's high or low, you just adjust accordingly.
Yeah, I think the idea was, to your point, people think about risk a certain way, but from your lens, risk is, it's the same across both sides of the fence, right? For managed futures or for crypto, to your point, you're just managing that on an ongoing basis like you always have, just a different asset class.
Yeah, so it's very similar to futures. The leverage is very similar to futures. And like it's just like a lot of allocators have always done in futures. Like they have a master account, they have sub accounts, and they leverage up low risk managers and they leverage down high risk managers. And we do the exact same thing. It's just sort of common sense. And the idea I mean, at the heart of it, what you're really trying to get is people who make high Sharpe ratios, good returns, and they're not correlated to the other managers. So, look, if you have two managers that aren't correlated and you put them together, the Sharpe ratio goes up 40%. If you have, four managers, you're doubling the Sharpe. Like, the Sharpe really goes up dramatically if you have multiple uncorrelated managers. So that is our goal. This is why we kind of stayed away from the beta plays and the VC plays and all this stuff that's pretty popular in crypto. Because look, if you have a bear market, you're going to be down 60 or 70%. But like, for example, like August has been kind of a month, but it's actually pretty good for a lot of these short-term managers. Just the price action suits them.
Yeah, 100%. I'm curious to kind of dive into like the SMA side of the thing, of the business. Cause you work with these managers, you set up these separately managed accounts, SMAs. Talk to us about the operational aspects of that. Like, is this if you go to a manager, whatever, they have a 6-month track record, they've just been managing maybe a couple $1 million, maybe their own capital, some friends and family. They have a good track record. You want to invest with them. Is it a heavy lift for them to set up an SMA for you guys?
It's not. So generally, all this stuff is done through like the offshore crypto exchanges, Binance, OKX, Bybit, and I would say that it's relatively easy. I have an associate who's doing all the operational work, so it's easy for me to say. But it's relative. It's probably easier than it is in futures, and it's relatively easy for the managers. And what a lot of managers found in the winter when they were losing the crypto winter, where they were losing assets, is that it's much cheaper to run an SMA than it is to run a fund. You don't have the audit costs, you don't have all this stuff. And for us, it's much safer. Like in a fund, if somebody's crooked, you won't find out for quite a while. But in an SMA, you'll find out like maybe within days. And it's pretty easy for us to evaluate everybody. We have tons of data. We have intraday data on every single manager that we have in our portfolio. So it's very easy for us to assess them. And so it's just, for us, it's just common sense to do it this way. And even when we launch a fund, it's going to be a fund of SMAs. So, I mean, maybe I would consider putting a fund in the mix, but it would have to be for a very good reason. Like, I'd have to have a lot of confidence. It'd have to be because what they're doing can't be done in an SMA format.
Yeah. Well, it's just like you're getting daily data, right? Daily returns, intraday returns, which is a huge thing versus waiting to the end of the month for something to find out that may not have gone the best that month, right?
Well, also if they're lying, right? If they're putting out fake returns, like how do you actually know? Like you just wouldn't know. But in an SMA, I mean, this is why in managed futures everybody uses SMAs. Plus, it's an efficient use of capital, right? So we can leverage guys up. So we could, for example, if we want to allocate 20 million, we could allocate 5 million at 4x leverage. And the leverage in the perpetuals in crypto are free. So we could just leverage them up and keep most of the money on the sidelines and not have to worry about counterparty risk and stuff like that. So there's so many benefits, and people have been doing it in managed futures for decades. And we've seen those lessons being learned, and we're just applying them to crypto. So I think that the managed futures background has been a big advantage in crypto.
Yeah. Is there any limitations of an SMA? Like, I imagine you probably couldn't invest in a fund that's let's say yield farming, because my assumption is they don't have the ability to transfer tokens.
Well, they do, really. I mean, you could have an SMA. I mean, obviously, if you're doing an SMA in DeFi, so if you're talking about that in crypto, then there's issues about security of the tokens.
Yeah.
If you're staking, if you're doing all these things, like you'd have, like, there are ways to do it that are safe, but to do it in an SMA, yeah, you can do it, but there are going to be some obstacles. And like I said, we've actually thought about this. I have friends who I trust, who run like DeFi funds, and I may invest in them. But right now, I just see so much return in the guys who are doing the straight S on exchanges that I kind of don't see the benefit of delving into the other stuff, which comes with all kinds of other problems.
Yeah, that makes sense. Yeah, I stick with what works, right? That definitely makes sense.
Well, if it didn't work, then maybe we'd have to look somewhere else. But yeah.
Sure. I guess the amount of allocation, I mean, how many managers are you identifying on a annual basis? Is there a specific number, or just kind of as you get new opportunities uncovered by who you talk to? What does that process look like for you guys?
Well, we're probably looking at 20 managers. We're adding new managers all the time, and we probably have pretty solid confidence on maybe a dozen of them. And we're hoping that number grows. So, like I said, the more the better if you're trying to diversify. I do think we have access to most managers that are out there. Like I think our tentacles go all over the place. So, and we try to talk to other allocators. So we always try to find out who's who. But probably the sweet spot is to have like eight directional managers, maybe 4 stat arb, and maybe 2 or 3 arbitrage, like regular cross exchange arbitrage. And those arbitrage are kind of like, a lot of that is sort of funding trades too. If you're familiar, funding trades where you buy bot, you sell perps, and then you collect the funding rate. So that works really well during a bull market, and those guys can make a ton of money. And it's a very simple trade.
Yeah.
Great.
Cool. Well, Emil, I know too, like this is a unique strategy because I don't hear about, or at least maybe from my perspective, I don't hear about a ton of other allocators, creating these SMA strategies. What type of advice would you give to somebody that is looking to, kind of run a similar ship like you do?
Well, it's very fee dependent. So, like, you have to get good fees on the exchanges, and so that's a tricky component to it. You probably have to use prime brokers. If you use prime brokers, you have counterparty risk. It's complicated because, like, if we raise money, we can't really raise it from US people. We got to raise it from offshore people. Maybe that'll change with the election. I don't know. But I know some individuals who just do it for themselves. And I would say you need more than $1 million in capital to do that. But I don't think you need more than 10 million. I think with a couple million, you can get a good portfolio of managers. And I know a few people who do that, and I talk to them, and they are very smart and they do a good job, and we share information. So it's all good. But what we're trying to do is just, launch a fund that makes it easier for an investor to get involved without having to manage this portfolio and have all the software and manage all the transfers. Like, it's a big job.
Yeah, maybe an opportunity to start a new company.
Yeah, well, I mean, like, we know our sweet spot when we're there. I think for most people, it's probably like it's probably not a trivial exercise to do it. Like, first you got to have an offshore entity, and then you have to have the capital, and then you have to have all the relationships. And so I would say if you're like a big family office, you can do it. If you're just a regular guy, just find a fund that does a good job with it.
Yeah, makes sense.
Any advice on the manager side?
Advice for the managers?
Yeah.
I mean, find what works and just keep doing it. If you're an arbitrage person, do that. If you're a stat arb person, just make it better. Some of these guys are pretty talented. I'm amazed. And sometimes it's just one or two guys, Sometimes there's a bigger team. Most of them are very smart. So they're young, smart, math, geeky tech guys, and that's perfect. And the fact that they don't know compliance, we can live with that.
Yeah.
Makes sense. I'm sure the element, as in traditional due diligence, key man risk comes up. Obviously, when you're dealing with smaller folks, 1 or 2 man shop, does that come up as far as your process with due diligence? As to any type of agreement there, or any that happens from a risk perspective?
I don't worry about their key man risk. I mean, like I said, we're trying to spread the risk around. And sometimes we see that, hey, performance has been drifting down. It's sort of fallen out of the normal range. And we find out that something's been going on with the company, right? So part of that is staying on top of what these guys are doing. And like some of these guys only have a few $1 million under management. So all of a sudden they start doing something in equities and maybe they forget about it. So you got to stay on top of them. But what we try to do is not to be dependent on any one. So again, it's the whole game at diversification. And like, I can't say enough, like let's say you're trend following in managed futures, right? You're not diversified if you have a team of trend followers. They're going to make and lose money at the same time. But what we learned in managed futures is that the short-term managed futures traders don't correlate to each other. Even in times of stress, they don't. So we've just taken that to the extreme in crypto.
Yeah, that's really interesting. That's an interesting approach.
Yeah, because you don't want, when things go crazy, you don't want all the correlations to go to 1 and your drawdowns go 10x and you got a big problem. So, I think we're really aiming to have the diversification really work over the long run. So even during stress times, stress times are probably your most profitable times, but things can happen. You have to be ready for it.
Cool. Anything else you want to talk about that we haven't covered yet?
No, I do think that, like I said, I am kind of down the rabbit hole. I do think the crypto industry is going to grow. I think there's going to be a big boom there. I don't know exactly when. Is it this year, next year? Well, this year's kind of running out. But I think people should take the crypto market seriously and look at do your research and look at it, because what we find is the more research people do, the more they realize, oh my God, there's something really here. So that's what I would recommend people to do the research in crypto. Look at Larry Fink at BlackRock, right? He was a big downer on crypto, and all of a sudden he's like a champion of crypto, right? If only
Bitcoin's biggest fan, yeah.
If only we could get the Democrats to have that attitude.
There you go.
Awesome. Well, Emil, this has been great. Really appreciate your insights. A lot of fun chatting with you. Give you a quick plug, where could people go to connect with you, and who does it make sense for? What are some people you want to talk to?
Well, it's sort of so Emil at KatonahEVE.com, and that's KatonahEVE.com. Anybody wants to contact me, we're on Telegram, evango1. And if you're a crypto trader, or you're doing short-term trading, want me to take a look at what you're doing, that's great. Or if you're an investor in managed futures, give us an email and be happy to talk if you want to see what.
Very cool. Emil, this has been great. We'll make sure to include all that in the show notes. This has been a great conversation.
Excellent. Well, good luck.
Thanks so much, Emil.